Every so often a company comes along that just seems to have it all. A charismatic leader, a game-changing idea, billions of dollars in funding, a brand that feels less like a business and more like a movement. But what if I told you that one of the biggest of them all was built on a foundation of pure, unfiltered hype?
Just look at this number, $47 billion. That's what WeWork was supposedly worth at its peak in early 2019. This made it one of the most valuable startups on the entire planet. They weren't just renting desks, they were on the verge of changing how we work forever.
And then, poof, in just 4 short years, that $47 billion completely vanished. The company's value didn't just drop, it fell off a cliff, plummeting to less than $50 million. We're talking about one of the most spectacular corporate collapses of our time.
And in November 2023, the final nail was hammered into the coffin. WeWork filed for Chapter 11 bankruptcy. So the big question is, how on earth does a company fall so far so incredibly fast? Well, welcome to Money Lessons by History. In this explainer, we're going to break down the wild ride, the meteoric rise, the unbelievable mismanagement, and the huge financial lessons from the spectacular crash of WeWork.
To really understand how it all went so wrong, we have to go back to the beginning. Because it all started with this incredibly powerful dream, a dream that investors were willing to bet billions and billions of dollars on.
Okay, so the core business, founded back in 2010 by Adam Neumann and Miguel McKelvey, was co-working. Now, on paper, it's a pretty straightforward real estate play. You sign long-term leases on huge office buildings, you chop them up into cool-looking, flexible spaces, and then you rent them out on short-term memberships. Sounds simple enough, right?
But here's the thing. Adam Neumann wasn't just selling office space. No. He was selling a vibe, an experience, a community. He grew up on a kibbutz in Israel, and he pitched WeWork as a kind of kibbutz 2.0. This wasn't about desks and Wi-Fi. He said it was about elevating the world's consciousness. It was a physical, social network.
And this quote right here, it says it all. When Forbes asked him how he justified the company's insane valuation, Neumann didn't talk about profit margins. He literally said it was based on energy and spirituality. And the craziest part? People bought it. He convinced some of the smartest investors in the world that this wasn't just a real estate company. It was a world-changing tech company.
And once that story took hold, man, the money just started flowing. We're talking about a fire hose of cash that fueled one of the fastest, most aggressive corporate expansions the world had ever seen. I mean, the speed of this growth was just breathtaking. They go from a single spot in New York to being an international brand by 2014. But the real rocket fuel came in 2017. That's when Masayoshi Son of SoftBank dropped a staggering $4.4 billion. That single investment shot them into the stratosphere, getting them to that $47 billion valuation just 2 years later. All of a sudden, they were everywhere.
But here was the fundamental flaw in the whole plan. WeWork was being valued like a revolutionary tech company, but it was operating like a traditional real estate company. Just look at the comparison with its main competitor, IWG. You probably know them as Regus. IWG had more locations, more members, and was actually profitable. Yet its valuation was just a tiny fraction of WeWork's. WeWork was focused on blitzscaling, just growing as fast as possible, no matter the cost. And boy, were the costs astronomical.
And as this empire got bigger and bigger on the outside, the cracks in the foundation started to become impossible to ignore. The story they were selling was incredible, but the reality behind the scenes was, well, it was pure chaos.
The whole culture was a reflection of its eccentric leader. Adam Neumann was famous for walking around the office barefoot and even had a private sauna installed. The company mantra was basically work hard, party harder, with these legendary alcohol-soaked parties. And the spending was completely out of control. We're talking a $60 million private jet, investing in a wave pool company, starting an elementary school called WeGrow. It was just wild.
And the financials behind this party culture were absolutely terrifying. Just look at these numbers. By 2018, the company was losing pretty much $1 for every single dollar it brought in. In just the first 6 months of 2019, on its way to that $47 billion valuation, mind you, it burned through almost another $1 billion. It wasn't a business, it was a cash incinerating machine. Now, if you're enjoying this story, don't go anywhere. There's still crucial information you need to know about how WeWork's empire started to crumble. Make sure to subscribe to Money Lessons by History so you don't miss what comes next.
And beyond the insane spending, there were some massive, glaring conflicts of interest. For example, Neumann would personally buy buildings and then lease them back to his own company, WeWork, so he was basically his own landlord. In one of the most infamous deals, he actually sold the trademark for the word "we" to his own company for nearly $6 million. Now, he did give the money back after a huge outcry, but it just showed a shocking lack of oversight from a board that was basically asleep at the wheel. This all finally came to a head in August of 2019. WeWork was burning through cash and needed more, a lot more. The only way to get it was to go public. And the paperwork they had to file for that IPO, well, that was the moment the entire illusion shattered.
And when things unraveled, they unraveled brutally fast. First, the IPO filing, called an S-1, was made public. Wall Street read it and was absolutely horrified. The backlash was immediate. The valuation was slashed from $47 billion to under $10 billion in just a few weeks. The IPO was pulled. And just like that, Adam Neumann was forced out of the company he had built.
So what was so shocking in that filing? Well, for the very first time, the whole world got to see the detailed financials we just looked at. They saw these complex corporate structures that seemed designed to benefit insiders, and they learned that Neumann had a special class of shares that gave him 20 times the voting power of a regular shareholder, giving him near total control. The magic was gone.
But get this, even after being kicked out for nearly destroying the company, Neumann didn't leave empty-handed. SoftBank, in a desperate attempt to salvage its own massive investment, paid him $1.7 billion in stock buyouts, fees, and credit just to walk away. It was a golden parachute so big, many people called it a reward for failure.
You'd think after the IPO collapse and the bailout, things couldn't possibly get any worse, right? Wrong. In 2020, the COVID-19 pandemic hit. The massive global shift to remote work was the absolute worst-case scenario, a brutal, final blow for a business model that depends entirely on people wanting to come together in an office. So after all that chaos, what can we actually learn from this incredible story? Because buried deep in the wreckage of WeWork are some really powerful money lessons that apply to all of us.
First and foremost, hype is not a business model. A fantastic story and a charismatic leader can take you a long way, but you can't defy financial gravity forever. Sooner or later, the numbers have to work. Your valuation has to be backed by actual profits and a business that can sustain itself.
Second, we all need to be more careful of the founder myth. This idea of giving a single, visionary founder complete, unchecked power is a recipe for disaster. You absolutely need a strong, independent board of directors to provide accountability and, just say no sometimes.
And finally, you have to know what business you're actually in. WeWork desperately wanted to be a tech company, but it wasn't. It was a real estate company. It had massive long-term debts, all those building leases, and very uncertain short-term revenue from its members. That mismatch is incredibly risky, and no amount of kombucha on tap could change that fundamental business reality.
The WeWork story is a massive, blinking cautionary tale for Silicon Valley and investors everywhere. But it leaves us with one big question. The next charismatic founder with a world-changing vision is out there right now planning their pitch. Have we actually learned our lesson? If you enjoyed this breakdown, hit that like button, share your thoughts in the comments below, and subscribe to Money Lessons by History for more real stories that teach powerful money lessons.